One of the things that most traders are concerned about most times is win rates, right? So I'm going to show you not so much the strategy as a whole, because I talk about that so much here on this channel. And if you're interested in learning this very simplistic supply and demand style of strategy, in which I talk about using multi-chart confluence, marking up my higher base chart first, and then just simply moving down, looking for a zone or a level on the inside, whether it's demand or supply, on the inside of the higher base time frame or higher time frame chart zone. Okay, so like I would mark up, say for example, this being a supply zone off of my 120 range chart, and it could be, you know, a 5-minute chart maybe for you. I'm not saying that the 120 range chart is comparable to a 5-minute trading chart. I'm not saying that. I'm just telling you that whatever you're using for a higher time frame standpoint, and then scaling down to the lower time frame. So I would mark up my higher time frame chart first, and then move down to my entry chart to look for a zone on the inside. So if this is an area of supply, then I'll look for a pullback to this zone here off the higher time frame, but moving down to a, say for example, maybe you're trading from a 5-minute chart and you're scaling down to a 1-minute chart, or a 60-minute chart scaling down to a 5-minute chart. I would move down to my entry chart and look for a supply setup on the inside of this zone here. Now, what I want to talk about today is one of the most critical parts to it all, which is the imbalance part to it, the component of trading the imbalances resting back at the actual zone itself. You hear me say that so many times here on the channel. Well, that's what's going to mark it, that zone being either a high probability entry or high probability zone versus a low probability zone. You have to have that gap or the imbalance resting back at the zone. So I call it the imbalance trading method. All right. This has helped me, you know, perfect a solid strategy of having a 84% win rate or higher, you know, when I'm trading. So that's very, very crucial. But the centerpiece to this all, the number one component that you need to always master, and I talk about this, any beginner trader watching this video today, is market structure. That is extremely important. I mean, if you think about it, you want to know which way to trade, right? You want to know if you should be going long or be going short, and it's all centered around what is the market doing. Are we reversing from the downside to where the market was very bearish? And how do you identify that? Just simply where the market is making lows, lower highs, lows, lower highs. Moving to the downside on a channel, for example, where you can see, say this is a trend channel to the downside. You can mark it up like this way. I know some people use trend lines, and when the market is breaking and maybe reversing, having a head and shoulder pattern from the top, like this right here, you see it, shoulder, head, shoulder, reversal, market moves down. Maybe you have a trend line going to the downside each time it breaks that trend line, meaning breaking below this low or this low or this low, and a pullback to a key area, whether you're trading like break and retest, like this would be a break, pullback, retest of this low right here, go short, right? A break, retest, back to this area here. But in this case here, you see we didn't tap into the supply zone, but we tapped into the basically an area of resistance right here. So this would be the ceiling, right? A low, lower high, push down, pull back, broke below this low here, look for pullback to go short. So break and retest, but I don't trade that. I trade supply and demand. So I'm looking for opportunities in which the market is moving to the downside, if it is like this right here, and then pull back to key areas of supply. Beautiful area of supply resting right here. Now let's talk about the imbalance or gap resting back at the zone. Again, this is all part in trading the future markets, whether you're trading the micros like the MES or the MNQ, or the full on NASDAQ, the NQ, or the ES, the E-mini S&P 500. So if the market pulls back to this supply area right here, everyone asks, well, how do I identify what is the imbalance or gap resting back at the actual zone? Now, if you know anything, I know people trade supply and demand quite differently, but the way I do it is I mark up my zone first, and I'll talk about that in another video. I've had a video here on the channel, but I like to sometimes recap videos because make new content in reference to content that's newer. Okay, so you don't have to go back into the channel looking for it, but you can go to the home page, and I do have a video talking about the zones, the markups, how I do it, whether it's a supply or demand zone. Now, this case here, this is a supply zone. This is how I draw it up. The essential component, what makes it or marks the zone being high probability versus low probability. And I'm not a swing trader or position trader, guys. I'm gonna tell you right now, this is a scalping strategy, and it has a very effective 84% win rate, but it's all going to be surrounding how you actually trade. Okay, now I am very good at reading the market, so I've been doing this for years, so I can look at the charts pretty much within a matter of just a couple of seconds or minutes and figure out the direction and trade. Okay, now yes, the market's going to reverse. We never know when it's going to reverse, but you trade based on what's going on. All right, I like to catch the market when it is reversing and look for basically the first pullback and the direction, which is changing trend. Okay, so like right here, this would be inverse shoulder, head, and then inverse shoulder here, breaking structure and a pull back to a key area like this right here. This is a valid demand zone, okay, coming to the downside here. So valid demand zone here, take the break to the upside right there, right? Or this is actually the first break right here, because this would be the first shoulder inversely, head, inverse head, and then inverse shoulder right here. So this is actually the first pullback to this demand zone. Now, how do we mark up the imbalance? Let's talk about that right quick. It's going to be a very quick video here. All right, so the way I do it, I'll remove this box here. I'll show you an example from a supply perspective and a demand zone perspective. Whatever your last, first of all, identify the breaker structure, okay, and identify the swing, which includes or marks up a breaker structure. This is a low, okay. We got a pullback here, breaker structure. I like to basically, how do I say it? Picture or identify nice swings when we're looking at a breaker structure. We have a low and then followed by a few candles pullback, 2 or 3 or more on a pullback, creating like an A-shaped pattern or an A-shaped pattern from the tops. Like this the low, this the point of the top of an A, and then coming down. That's a breaker structure right there to the downside. Now, the last bullish candle to the upside, we're talking about supply zones right here, from the bottom of that bullish candle right there, okay, the bottom end including the wick, to basically look at the candle that broke below that last up bullish candle. Not this candle. This candle here broke it to the downside. We're looking so basically to be the third candle right here. So I would take my, like say for an arrow line or just a regular line, the bottom end of the bullish candle, that starts where the gap will be marked up from, okay, or imbalance. This candle broke below this candle right here, the bullish candle. The next candle, okay, we're looking to see how far it pulls back. So as it's pushing down, it may pull back some. And the wick of it, right, and to include the wick, did it come back and tap the arrow line right here, the line? This is the bottom. This marks the beginning of where the imbalance should be, marked off, or where it starts from. This right here, the top of that third candle, would be how far on a pullback that candle, including the wick, pull back to. So this is the imbalance, is the in-between area from the bottom of that bullish candle to the top of that third candle right there. That's the gap. That's the imbalance. That's what we're talking about where we're looking for like imbalance trading. Okay, we're looking for areas where the market is leaving gaps within the market as it's pushing lower. All right. Now, some people trade, or traders trade fair value gap, opportunities like right here. This candle, next candle, third candle. This would be the bottom of that bearish candle to the top end of this bearish candle here, the third candle. That's what's called or classified as a fair value gap. We can talk about that in another video, but I don't trade it, so that's why I don't really talk about fair value gap trading. But the market does sometimes, you'll see it may just pull back to like a fair value gap area and then reject, like right here, pushed up, pull back, came and filled the gap here, and then rejected off of it as pulling back and then coming down, filling back down to the demand zone. But this is how you mark up an imbalance area back to an area of supply. So that's one example right there. Let's talk about example 2 from a demand standpoint. That was from a supply standpoint right there. And again, I'll try to recap or cover another video surrounding how I actually draw up my zones. As you can probably see it now, just looking at the 2 examples here. So I'll remove this box here to the downside. Okay. So if you look now that we are made this low here, this is a major low, makes a high, higher low, and then breaks above this structure area right here above 19,859, we'll call it, right? There's an imbalance here. So as the market pushed up here, it pulled back. So we have a down bearish candle, push up, and then this last bearish candle to the downside, okay, which didn't take out this low here, so that's the last bearish candle to the downside. We look at it inversely. So first candle didn't break, second candle didn't break, the third candle broke, right? So the third candle is what broke above this last bearish candle to the downside. But before I even, look at all that, I'm marking up the last bearish candle, the top of it this time, not the bottom, but the top of it, because we're talking about a demand setup. This candle breaks above this bearish candle right here. That bullish candle broke above that bearish candle. Whatever is the next candle after the break that breaks above the bearish candle is going to be this candle here. How far back did that candle pull back? All right, including the wick. It pulled back this much. So sometimes in play as the market is actually moving and we're in real time, with the data feed and the market's moving, this candle is pushing up and then maybe it comes back, right? The wick end of it comes back this far. So it doesn't tap into our top candle, or not top candle, but our first line we drawn, which is the top end of where we start off the imbalance area. Okay, so there's a and then the next line, which marks the bottom in that bullish candle, that's our gap. That's the imbalance area in which we're looking for the market to come back to. Both of these examples, what I'm showing you is that because there's an imbalance, that makes it a high probability zone in which we can actually trade. So if we move the box back, we have our demand zone, we have the imbalance resting right there. This is a valid demand zone to trade off of. And when the market pull back after it reverses, got it, break a structure, pushed up high, higher low, didn't want to take out this major low, so it took out this high and this high. That's a break of structure, taking out two areas. This is the reversal, inverse head and shoulder pattern, and then the market comes back and taps our demand zone right there with a high probability area because of the imbalance, right? So the market pulls back to this area here. We're looking for rejection to go long. Not looking for rejection to go off the 120 range chart or whatever higher time frame chart you're trading off of. I like to move down to and scale down to a lower base chart like my 24 range chart, and then look for, once we tap into the higher base zone I marked up, scale down to my 24 range chart to find a lower time frame or lower base chart, a supply zone resting on the inside of the zone here. That's how I'll do it. I'll talk about that type of content surrounding the strategy and lots of video content. But what I really do is I really go into detail when it comes to the trade breakdowns. If you're into anyone that's interested in that, it's a Discord community, and the Discord is free. And if you're interested in joining our Discord, the link is down in the description portion of the video. The second link below that is where you can become an elite channel supporter or member for only $6.99 a month. I don't charge hundreds or thousands of dollars for the video content covering the strategy and how I trade, breaking things down. So what I do is I go on the Discord, okay, and I engage there with the other community members, but I'll post my trades over on the Discord. Then what I'll do is after the session has ended, I do this several times a week, I'll go and break down the trades I take for the private community so that you can understand what I was thinking, why I took the trade, what zone I took the trade from, or what levels I took the trade from, as well as covering market structure, what I was looking at, okay, what, allowed me or my thought process and why I took that trade. But then I also go into detail about the stop loss placement, where to place your profit target areas, why you should place it in, the stop loss and the profit areas in those particular, locations on the chart, right? I talk about that. So if you're interested in becoming an elite channel supporter, the link is down below. Click the link, choose the second tier for $6.99, and you'll receive all the trade breakdown videos. There's tons of them on there. It's basically an educational tool that you can use to, basically educate and teach yourself, and also me explaining these type of setups. You can look for the same similar type of setups on your charts yourself. But, going back testing and forward testing, you want to put time on the charts, lots of time, okay? But again, the link is down in the description portion of the video. Again, you get the trade breakdown videos, which is tons of them, the video playlist, and a great video that I cover surrounding the concept of market structure. If anyone is struggling with that concept, that is the most important, critical part of trading that you need to know, because if you can't read the market, then how are you really effectively going to know which way to trade? Right? And you need to, because the markets are designed for you to lose. You want to make money, do it the right way, understand it, and learn how to read market structure. But outside of that, that's all I have, guys. I want to talk about the imbalances, because that is the most critical part to the strategy and actually how I trade. And if you get the markets right, most times you're going to have 100%, win rate on the day, or maybe 90%. It just depends. Win rates are, I don't gauge my win rate based on, I basically base it on the number of trades I take, but really, to be honest, I'm only looking to take 1 or 2 trades. That's my max of trading for a day. So, but I could get into a trade and then exit out of it real quick because maybe I didn't get into where the trade exactly right at the moment I need to. So I jumped the gun, I got in aggressive. So sometimes, well, not say most times, but sometimes I'll back out of the trade and close it out, right? So I'll close the trade out, and then I may re-enter once I get a better placement or a better position. I mean, I covered that like a couple of videos ago where I took a trade on one of the live recording videos, and I got stopped out real quick. Why? Because where I placed my stop loss at, I didn't move I placed my stop loss where I needed to. That's why I talk about in strategy where to place your stop loss. Okay, because it's very important. Never want to do it tick to tick on the back end, the point of rejection. You want to give yourself a little breathing room there. 2, 3, 4 ticks. 2 or 3 points. Is what you want to do, mostly between 3 and 4 points, okay? But I talk about that, especially on within the Elite Channel membership or supporter program there. So again, that link is down below if you want to join, because that's very, very important where to place your stop loss at, because the market makers, the institutions, the banks, they like to play games. They know what people are mostly get into a trade at, because they're setting up the traps. They're setting up the setups themselves. Okay. So they know when people are going to most times get into a trade. Like you got into a trade right here, it just makes sense. So they know that people are getting in right here. So if you got into a trade, the market goes up, they come back, they may test your stop loss area tick to tick, because they know maybe you got your stop loss resting around the back end of this entry point after this candle close. So you've got to give yourself a few points breathing room. If you put it too close and the market's very volatile, it may come back and stop you out real quick. That happened to me. Okay, I didn't move my stop fast enough after entering the market. So I saw an opportunity to get back in at the right entry point, and I did. That happens sometimes, so you just have to know where to get out. But anyways, just want to cover this content. I'm going to go ahead and wrap this up. If you're not a current subscriber, please take the time to go ahead and sub by clicking the sub button down below. Make sure to turn your post notifications. How do you do that? Just simply click the bell. The moment you hit the subscribe button, click the bell next to it. That's going to turn all your post notifications on. It should, so that you receive all the video content each time I post. But outside of that, that's all I have. I appreciate you guys tuning in. I hope everyone has a fabulous Mother's Day weekend. For anyone out there that is definitely celebrating, and whether you have kids or a wife, significant other, whatever it may be, and just make sure to enjoy the weekend. And I'll see everyone on Monday. Over on the Discord channel. So again, I just wanted to cover this content today, and I didn't trade yesterday. I'm gonna say that right now. I put that out on the video before last. Yesterday I had some things I need to take care of, but anyways, have a great weekend. See everyone on Monday, and I believe next week let's look at the calendar right quick. I do want to see what the calendar consists of next week. What's on Monday? That's the most important thing. Monday we have I'm looking at see if it's anything at 8:30. Nothing at 8:30. There's something at 10:25, but it's low impact, and FOMC member speaking. Other than that, 2 p.m. we have the federal budget balance at 2 p.m. It's low impact. But just be mindful of, anytime we have USD news, that it can slightly impact the market one way or the other. But if you're not privy to an economic calendar, I use Forex Factory for futures trading. Just look at what's on the books for the economic calendar for each day of the week, because you definitely do not want to be trading when there's a orange or a red folder that is high to medium impact news that will greatly affect the markets. Okay, but that's it, guys. Take care. I'll see everyone next week, and I'm going to jump off the video. Goodbye.